We have Frank Cicero from Jefferies, Todd Baker from Union Bank, and John Eggemeyer from Castle Creek. You can tell that Todd's really, pulling yeoman's duty here because he had a little ski accident, but he refused to throw in the towel. And we have a huge debt of gratitude to extend to him for making it here to join us today.
If you ask my wife, she might say that this is just a good example of male stupidity.
I'll refrain from asking your wife about it. I'm not going to give Frank Cicero any credit because he left New York a little in advance of the snowstorm that's coming in. And then with John, he's coming to us from California, so a short flight. Maybe a little thank you to you, but the whole issue and idea that we're going to really focus on is M&A related to capital raising. And I'm appreciative of each man's time because they bring a different perspective to the audience today. With Frank sitting here, he runs the financial institutions practice at Jefferies, and I believe he was involved with that BB&T Susquehanna deal in some capacity.
Observer, unfortunately, but we did other deals.
Other deals. Maybe I'm reading the news wrong these days. I know I'm not reading the news wrong, though, with John Eggemeyer. With Castle Creek, they're one of the most active investors in banks today and have been since, I think you founded the company in 1990, if I'm correct.
25th anniversary.
Oh, 25th anniversary, so congratulations to that. And then finally, Todd comes to us from one of the oldest and most respected banks in California, also part of one of the largest banking systems in the entire world. I think $2.5 trillion for the parent company.
It's a lot of yen.
A lot of yen from the Japanese. Anyway, it's not my job to talk, it's theirs, so I'm going to pass everything over to Frank. And again, guys, thanks for joining us.
Thank you.
Thank you. Thanks, Al. And thank you again to Todd Baker for playing hurt. And guess looking around at a full room, it says a couple things. Al and the team at Bank Director do a great job. And there are no NFL games on today other than the Pro Bowl. So we will try to be at least as interesting and as exciting as the Pro Bowl.
Low bar.
What we wanted to do, though, is try to identify maybe an emerging trend and something we think will be more important in the next year or so. And with the M&A environment moving away from the kind of merger of equals, strategic merger trend that started 2 years ago, where many transactions were all stock transactions at a relatively modest premium, and that was a very welcome trend. That investor reaction to those deals were very good and helped set the stage to what we saw in the past 12 months, which is a little bit more traditional, higher premium, change of control transactions with the larger banks gradually coming back into the game. We think going forward, especially for small and mid-sized banks, the ability to put cash in transactions which could necessitate raising capital simultaneously with the transaction will be of increased importance. Over time, about 75% of bank M&A transactions, I think we looked at about a 10-year average, have cash as a form of consideration, and saw this especially in the larger transactions that have been done. The BB&T deal, there's some cash in the Susquehanna deal. The City National transaction was 50-50. One West CIT was, I think, 60% cash. So we think this will continue, and simply stated, smaller and mid-sized banks over time will be at an increased disadvantage if you're not able to compete with cash. Cash, from a seller's perspective, is a good form of price protection. Many sellers want to give their shareholders a choice. Some shareholders want the tax advantage and future value of stock. Others want the cash, which is why over time you see a lot of 60-40 or 50-50 transactions. And for the buyers, there's advantages to cash transactions because you're just issuing fewer shares. So there's two trends kind of interceding here: more cash transactions and a world where regulatory capital requirements are higher, where overall scrutiny on the part of regulators to get deal approvals is high, and where most buyers are going to talk to the regulators before transactions are even announced. So we think that leads to increased probability that in specific instances, the regulators necessitate a capital raise in order to get a cash or part cash deal done. So I think the message here is don't wait for that M&A process to start before you think about your options as far as raising M&A related capital. And some of our comments are, I think, probably more apropos to publicly traded companies, but that the privately held banks are no exception. Broadly speaking, there are more options than maybe than you would realize for how to raise Tier 1 or common equity in an M&A context. Don't assume that your only option is a publicly registered traditional common deal that happens some months after the announcement. There's a good deal of risk associated with that, especially if it's a significant transaction compared to your size. And you do have a number of things you can do to mitigate that timing risk between announcement and close. As you begin to think about M&A related capital, you're going to go through a few important questions. First is just the size and the materiality of the transaction. And if this is important from a couple of viewpoints. Number one, obviously the bigger the size, the more likely it is you'll have to raise capital to get regulatory approval if there's a lot of cash in the deal. And two, if it is deemed material, and we don't have to go into all the technical definition of what materiality is, but if it is material, you would not be able to go in and do a traditional public registered offering without having pro forma financials. You will then need to get comfort around those financials in order for any underwriter or investor to buy the offering. So that will cause delay. So if it's a material transaction, that does somewhat limit your ability to raise common in a public forum simultaneously with the announcement. Another discussion point will be, what type of Tier 1 do you need? Do you absolutely need common? Can you look at a convertible preferred? Can you look at a straight preferred? Again, it's very helpful if you have an idea for what the market is for all of these capital instruments before you get into the M&A negotiation. Three, the likely investor reaction to M&A announcements. We're in a nice 2-year period here where market reaction has been pretty good. That hasn't always been the case. It won't always be the case. And while the buyer always wants to think that the stock price is going to go higher, if it's a transaction that's significant, it's a market extension transaction perhaps, there's no sure thing what the reaction is going to be. And it's another reason why you may want to look at raising capital simultaneous with an acquisition, maybe through a private placement, rather than waiting after the transaction and taking investor risk as well as timing risk. 4, because of some of the unique timing circumstances with bank transactions, some of the risks kind of work against each other. By that, I mean, well, say you decide to raise common close to or simultaneously with the announcement, and the closing is not going to be for 6 or 9 months. Now you have something of a drag. You have shares outstanding, you have common equity you have to earn on before the transaction and the earnings all close. And there are ways you can raise capital of a contingent nature so that if the transaction does not close, you can pay that capital back. And I think that's an aspect that especially small and mid-sized public companies may not be aware of. In general, private versus public, more often than not, a bigger acquirer is going to go the public route, especially if they're just raising capital. Maybe they don't need it for regulatory approval. Maybe they just want to tap up the capital levels, create some cushion for the next deal. But again, for smaller and mid-sized acquirers, don't be afraid of the potential of doing a private transaction. The acronym is a PIPE, a private investment in a public company. There are a number. The number of buyers for privates is gradually increasing. They include firms like John's, more traditional private equity firms with a FIG focus, Also, some of the large institutional, traditional bank stock investors, such as Wellington, have pools of money committed for potential privates. So again, if you take nothing else away from the presentation, it's that you do have the options and you should not discount the private route for at least a portion of the capital you may need. So we have the First Niagara case study, and this isn't to criticize that deal. They had good advisors, a lot changed after the announcement, but this really kind of crystallized the timing risk involved. And this is a situation where the buyer knows you need to raise capital for regulatory approval. The decision is made not to raise any capital along with or very shortly after the announcement, and there's all type of market risk. And in this situation, First Niagara ended up issuing 30% more shares than they would have because of the decline in their stock price. So again, this is a risk that is really unique to financials and to banks, and really, again, you need to focus on it before you start negotiating the M&A transaction.
Frank, it's really tied to the fact that unlike almost any other industry, it's 6 to 9 months or more before the transaction closes, and so that risk is real.
Absolutely. Since you all have all of these, and it's absolutely impossible for me to read such small print to you, and be even more impossible for you to want to sit there and listen to me do it, you do have access to all of this information on your iPads. But the two options as far as common is, of course, a registered common offering, very straightforward. Pricing discount is the least. An unregistered common equity offering, either Reg D or 144A. And it's just, so here's a potential situation where you would use this. It's a material transaction, so you can't do a public offering simultaneously. You can do a private placement without pro forma financials for either some or part of the common you need, and then register those shares via a registration statement after the fact. That timing lag does create discount. There are fewer investors who will buy that, but that may be worth it rather than taking all the timing risk that we saw illustrated in the First Niagara graph. The convertible preferreds are, you should consider them for two reasons. One, just the pricing. If your stock is liquid enough to support a convert, the conversion, the pricing, it's priced at a premium to your current stock price. So that's EPS friendly. And second is the ability to put in a contingent feature. We don't need to go into all the differences between a mandatory and a more traditional convert. But the takeaway is, and there's precedent for this, you can go in a private placement and raise convertible preferred stock, announce that simultaneously with the M&A transaction, and have a feature in the convert so that if for some reason you do not get regulatory approval, the transaction does not close, you pay the investors their money back. Usually there's about a 1% premium you pay for that feature. But this is potentially very attractive, and it's being used, it's not common, but with increasing frequency. Excuse me. The forward equity sale is really more for bigger, more liquid public buyers. This is probably the most tried and true of these more creative offerings. And what it simply is the buying bank goes out to a broker-dealer. The broker-dealer goes into the market, enters into a forward agreement with the broker-dealer. Broker-dealer goes into a market and borrows or sells short some number of shares of the buyer's common stock. Those proceeds are then essentially put into escrow, and when needed, some months down the road, the proceeds can be delivered to the buying bank in return for the shares which the broker-dealer uses to cover the short. This is tried and true. A number of banks have done it, mostly larger, Bank of New York, State Street. Back in 2004, actually, the old Colonial Bank, when they were acquiring in Florida did a $200 million forward. It was very effective. So, another thing to keep in mind, and the benefit here is the shares don't all go into the EPS count day one. So it provides some flexibility for that 6 to 9 months. You don't have all these shares weighing you down. And so one thing you can do to prepare, if you're a smaller publicly traded bank, talk to your broker-dealer, get some feeling about what the borrow is of your stock and whether or not this is applicable for you. In addition to a Jefferies commercial, this slide points out a specific transaction. This was back in 2012. Oriental Bank in Puerto Rico bought BBVA's subsidiary on the island. It was a $500 million acquisition. The seller here demanded that the buyer, our client, raise at least some of the capital simultaneously with the transaction. So we structured a convertible preferred very similar to what I just described. They did about half of it simultaneously, and then they did the other half in a traditional common offering and a straight preferred offering 3 or so months later. So they took some of the risk off of the table. I just think this illustrates the flexibility that you have and the fact that some of these things have been done and you can use them. So before turning it over to Todd, I would just reiterate again, probably for the third or 400th time in this presentation, think about these things ahead of time. And if you are not publicly traded, that does not mean you can't think of some of these contingent convertible structures to talk about with private equity firms or other private placement buyers. In general, the pool of private placement buyers is increasing, and this gives you some optionality versus just a traditional public offering. I think I'd like to now turn it over to Todd, who in his role on all sides of the business, whether it be lawyer, working for a big bank, has a real unique perspective about this issue and really all bank M&A issues. Todd?
Great. You got the little clicker? I got to go through the rest of your presentation.
Sorry about that.
That's okay. There we go.
There you go.
So just to remind folks, I'm here really as a representative of somebody who would likely be competing with you for a target that you are interested in. And I come to the table with tremendous advantages because I can offer cash. I can offer cash without doing anything in terms of the financing options that you'll have to look at. So why are we interested and why is Union Bank active in the M&A business? Well, as was mentioned, we've been in the banking business since the 1860s in California. Today, we're about $110 billion in size, still with a retail presence largely in the western U.S., although organizationally now combined with the national and America's activities of our parent, known as MUFG, but more traditionally known as the Bank of Tokyo Mitsubishi, which has large capabilities in investment banking and corporate banking around the world. We're sort of what might be described as the biggest small bank, or maybe the smallest big bank, very focused on customers, always have the highest customer ratings in our markets in terms of satisfaction. In all the types of businesses that you would expect a bank of our size to be in, and many of them are essentially the same businesses that you're in, plus a few that are somewhat larger in focus. I mentioned the branches, and the fact that we're now organized ourselves as our all-foreign bank owned subsidiaries on a national basis so that all the activities of the parent bank and the subsidiaries are managed and risk managed in one place. So we've been very active in the bank M&A market and also what we think of as non-bank, and I just thought I'd mention a few of the things that we did in recent years. Like many of you, we did a couple of FDIC deals, one near our Northern California market in Marin County and the other up in the Seattle area. And then probably the signature transaction of the last couple of years was our acquisition of the #1 bank in the Santa Barbara area, Pacific Capital Bank Corp., which we bought from a private equity ownership group that had acquired it when it was in deep distress. And we paid all cash It's been a very successful transaction, but really an ideal type transaction for a bank like ours because it gave us the #1 position in a market where we, despite our long California history, really had a very small presence. So that's the kind of things that we're looking at on the bank side. As others have mentioned, we're also looking at things that you'd think of as non-bank. We picked up a couple of, because we, contrary to some of the conversation earlier, we really do believe that deposits are where it's at and that liquidity risk is going to be the biggest topic of conversation for the next 4 or 5 years if and when there is any change in the interest rate environment, because our point of view is that the current generation of bankers has gotten very, shall we say, I don't think lazy is the right word, but accepting of the idea that there's a natural right to deposits, which I think we will find that the competitive situation will get very different if and when there is a rate rise. So we bought a couple of banks in the homeowners association business, a couple of companies that did homeowners association banking, and caught some very attractive deposits, very sticky deposits. We also, selectively, like a lot of large banks, looked at big asset generators. So we bought from Deutsche Bank, a large high-end commercial real estate lender, and we also did some minor investments in bank technology space. So back to the topic at hand. I think we believe we have, as a large, well-capitalized bank with plenty of firepower, we have a significant advantage over buyers who need to raise cash to put it in the transaction. We can offer utter simplicity in our transaction. It's cash at a particular price. There's no price risk for the seller in our equity because we're not providing any. No value risk for the shareholders after closing either because the cash can be used there. No SEC registration delays. Higher likelihood for a clear path to regulatory approval because, as Frank mentioned, sometimes the question of equity levels of the surviving entity are a significant issue. And none of the seller financing risk we've talked about here. But that doesn't mean doesn't mean we win all the time because there are other benefits that having stock in a deal are very important for. And you saw, I think you mentioned the City National deal, so that's 50% stock. That allows the transaction to be tax-free to the extent of the people who take stock, and there are many shareholders, particularly large shareholders, as in that case, for whom that's really important. And we are at a disadvantage in that regard, in that we can't or don't want to offer our parent equity in most cases for a transaction. Also, we don't offer that great traditional opportunity in banking for the double dip. So as others were mentioning here, as I think Mr. Carpenter mentioned, people want to stay in the banking business to some degree because they think they're trading into a better franchise which has longer-term better prospects. But some of our advantage can be dissipated through the use of either the types of structures that Frank is talking about, market-based structures, or the types of things that John offers, which are essentially ways in which the various concerns of the selling bank can be balanced in a way that there's enough cash for value stability, and yet there's enough stock for the other desires of some of the players in the transaction. And Frank mentioned the various methods. Obviously, John is here as a representative of the private equity community, and a good one because there are long histories of good working relationships in his case. There are pipes, contingent equity, these perpetual preferreds. Frank and I, in our earlier life, worked on a lot of very complicated versions of these for large companies. But I think the critical issues that you have to think about is, today, it's really hard to take on additional leverage to do a deal. It used to be that you could lever yourself down, the regulators would let you earn it back over a period of years. It's really not very credible anymore. It's very difficult to dilute your capital base significantly in the context of any transaction, however good it looks. And so capital earned back is a big deal. Not just for the regulators, but also for the market as a whole. And we've talked, at any given moment, the cost of these different alternatives for equity raising is going to be critical to you because there's going to be a discount in some cases on the common stock you issue. There's the rate and the redemption premiums, et cetera, associated with the preferreds and the strike price. You always have to be thinking when you put cash in a deal. One of the great things about putting cash in the deal, if you have excess cash and don't have to raise capital, is that it's highly EPS accretive in your transaction, and you therefore get a good reaction in the market. Well, it's a little tougher when you can't lever up to do that, and so you have to be looking at these capital instruments in terms of how are they going to affect the accretion in the transaction and how fast it comes. Because I think at the end of the day, as banking becomes more normalized, that focus on EPS growth is going to take greater and greater importance again, as it has in other more stable parts of the cycle.
Ted, I had a question sort of related, but you've, and for both TD and Union, put together some of the bigger acquisitions by international banks in the U.S. As you gone around and tried to establish relationships with be it community or smaller regional banks, do they care that you're a big international buyer? What's the kind of reaction?
That's an interesting question because I think the initial answer is yes, because they fear that we are not fundamentally a domestic institution that they understand. But particularly in the case of the businesses we're talking about here, our retail banking and commercial banking business is completely independent of anything that might be happening in the parent bank, in part because the parent bank really doesn't know much about retail banking and commercial banking in the U.S. And so it's essentially run directly out of our operation, and we've found that the sellers' interactions are entirely with domestic empowered folks, and this turns out not to be a significant issue in the concern. There's often, just a fear factor associated with foreign ownership that can easily be dispelled because we have people working in the company who have worked for other companies that we've acquired and are pretty good ambassadors for our situation. So I think the one thing that I would advise folks here when they think about bringing in either a private equity group along the lines of our next guest, or particularly these situations where you're issuing PIPEs securities and you're bringing in big institutions, is trying to understand who are your new shareholders going to be, because it's a different kind of shareholder than most of you have had. These are shareholders with an agenda and an idea about where they want to get with you, with your stock, and what they want your future to be. And it's very important that there be a clear understanding that everyone is on the same page, because the last thing you want to do is create a dissident situation in your company as a result of doing a transaction that made sense at the time. And I think with careful thinking about who your partners are, that can be achieved. I mean, the Fidelities of the world really aren't interested in running your business. So there it's more about finding that they believe that your strategy makes sense. And with someone like John, you're really looking at track record and history and reputation, and the fact that he's not an in and out guy. He's in for the duration and trying to help you improve your performance in a non-confrontational way. But I think the point that Frank made really highlights one of the key questions you ought to ask yourself is, what's your exit strategy if your transaction for some reason doesn't go forward? Because as we all know, there's just a lot more regulatory risk than there used to be out there. You could, for the big banks, it's certainly, BSA, AML is everything. And that's pushing down towards you guys too. And so when you run into those problems, you can have a transaction that makes absolute sense at the time it was signed. I won't mention M&T and the thrift in New Jersey, yeah. But where the problem had nothing to do with the transaction at all. It had to do with something they'd done some months before. But there is more contingency in your regulatory approval structure. So you do need to think much harder than you used to about, okay, what if this doesn't work out? Is there a way for me to get out of these financing arrangements without trashing my next 3-4 years? And so I'd leave that with you as a key consideration. John?
Going to make me work, huh?
Yeah.
Okay. Let me turn the conversation in a different direction and talk about the role of private equity in the greater financing world, and whether it is in M&A or repaying TARP or some other form of financing, but try to understand the issues at hand. First of all, in terms of what drives your decision to use the public markets or the private markets, first place to begin is our market conditions, which are ever changing. There's no mystery that over the last 7 years there were times when not just small or medium-sized banks were locked out of the market, but all banks were locked out of the market. And it really brought the role of private equity more to the forefront to try to fill this vacuum that was created as the public market disappeared. That has healed substantially, but again, not for all institutions in all regions of the country. And I would posit that it would be more difficult to raise money for a bank in the oil patch today through the public markets, where through the private markets, I think you would get a clearer answer and find that capital available. The second issue relates to the complexity of the transaction. Again, the public markets work best in highly standard formats, in fairly standard homogeneous transactions. So the more complex the transaction, the more attractive the private equity market becomes. Size of the capital requirement is important, and there are multiple facets to this. Number one is that private equity today, through changes that were brought about in 2008, is in a position to own a much larger percentage of stock without having to become a bank holding company than was traditionally possible. And as I think about it, you can own up to 14.9 in voting and sleep comfortably at night. From my side of the table, you can own up to 33% total economic interest, with the excess of that being non-voting. The issue, however, is that your private equity or private investor is not going to do that without the approval of the Fed. It is not the same type of approval process that you go through in an acquisition, but it does take time. And so while private equity can respond very quickly, if that ownership rises above 9.9%, you can count on some delay for regulatory approval, and that's generally 60 days. The other aspect to it, which we'll deal with a bit later, is whether you have the authorization, in particular relative to common, to issue as much equity as you might in a private transaction. So to the extent that you are issuing more than 20% of your outstanding shares, that and that is being done below the market price, that's going to require a shareholder vote. So again, a timing consideration. Timing taken by itself, I think the one advantage, if you can meet the other criteria that we just went through, the advantage of private equity is they can respond quickly. We currently have 53 banks around the country that we're invested in. And we have been able to do some of those investments in as short a period of time as 2 weeks. So it can happen, and timing is a factor.
So John, how many of those 53 do you have a director?
Good point. So, Todd, 27 of those are banks in which we either have someone on the board, one person, or have the right to a board seat, or have observer rights. The ones where we don't have any of those, typically we are below 5% ownership, and would not be holding that investment for an extended period of time. I think we'll get to this concept later, but having spent 25 years now in this business, January 5th was our 25th anniversary. We've done over 100 transactions over that time period. We are deeply steeped in the banking business. I spent 20 years in bank management prior to getting into the private equity business. We very much cherish the idea of partnership in our investments and are looking for situations where we can have that direct involvement. The final issue, which is one that is really the issue, I think, in everybody's mind, is what does it mean? Okay, you have someone on the board. What does it mean relative to control? And I think we would hold ourselves as a director to the standard of trying to work within the context of the board to make that board more effective. To the extent that management is uncomfortable with a board that is well-informed and active, then the presence of private equity can be troubling. As Frank said earlier, we come in with a particular point of view, a shared vision, I think, and we're there to work with management to help them achieve that. It is not our goal to change management. If I look across all the banks that we're invested in now, we've only had a change in senior executive in one of them. So we do not look to get into situations where we do not have confidence in the senior executives. So what makes for a successful partnership with a private equity investor? One is a shared vision. It is really important that the bank, its board, and its key investors have a shared vision of the future. Personally, I'm not interested in being a missionary. As somebody once said, the thing I know about missionaries is the natives always eat the missionaries. So I'm too old. Second piece is to truly understand the business. And as the economy got into trouble in 2008, there were a number of private equity firms and individuals who came into this business with no background in banking. And where I have seen that, it has not worked well. Banking is a very particular business. It is highly regulated, a business where respect to the regulators and an understanding of that environment is absolutely critical. And so I think a deep understanding of the banking business is important. The third is a term I used earlier, and that is a partnership. What does come with a private investor that does not come with a public investor is in fact a sense of partnership. There is more than just the money that comes with that investor, and it's important to take advantage of it. If it's not something that you want in the conduct of your business, then the public markets are probably the place to be. The fourth, which comes in any partnership, whether it's with our spouses or our children, it's open communication. And I think that sense of open communication overcomes and shortcuts a lot of potential for future problems. So what's left? The first thing is from a regulatory, statutory standpoint, do you have the authorization? Do you have enough shares authorized? Do you have the right kinds of shares authorized? Have you had an open dialogue with your regulator to understand where they stand on these various issues? But that sense of authorization is a place to begin. And then, as Frank mentioned earlier, increasingly, especially in acquisitions, pre-clearance with regulators is really critical. One thing I know, given our portfolio covers most of the United States, is regulators are very different from one regulatory district to the next and from one regulatory agency to another regulatory agency. There's a lot less consistency than we would all like to see, and so what might make sense to me sitting in California in that district may not make sense to somebody dealing with the Federal Reserve in Atlanta, for example. So those are my issues. I think it's important as you think about all of this to in fact talk to people that have had private equity investors in their shareholder group. I think the experience over the last 5 to 7 years has actually been universally quite positive. But it is something that that each of you needs to discover on your own. So,
John, two quick questions. The view of the regulators towards private equity in banks has been not always positive.
right.
Well, what's the current lay of the land there as you talk to regulators about new investments? And then the second question would be your portfolio companies. How supportive a view of them doing acquisitions before they eventually potentially sell themselves or merge?
Two good questions. I don't think the regulators, especially the Fed, likes anybody. So I don't feel put upon as a private equity investor. I think that there was a great deal of paranoia early in this recession on the part of the regulators because I think they looked at traditional private equity and said, I see behavior patterns here that I don't like. And I think they were very fearful that would happen in banking. It has not. The other thing that most of you know is that prior to making an investment, we have to sign passivity commitments, which if you read them literally, doesn't allow you to do much of anything. I think on the acquisition side, the very first bank that I recapitalized, which was in February of 1995, was an $83 million bank called Rancho Santa Fe National Bank in Rancho Santa Fe, California, which is how we got there. That company today is $16.5 billion in assets through 28 acquisitions. It's PacWest. So I like acquisitions. If anything, we think it's a great way to enhance value. And I think in the environment that we're headed into, I think it's incumbent on us to plan on interest rates being flat forever. Because if we don't plan that way, and in fact it turns out that that's the case, we'll all be very unhappy. And I think that the challenge that puts to us is our deposit costs can't get cheaper. Our loan yields are coming down. We're getting squeezed, which really then puts us in the classic position of all mature industries, and that is high-cost producers get taken out by low-cost producers. And I think that it is incumbent on all of us, and certainly we're working actively with our portfolio companies in this regard, to do anything possible to reduce the cost of operating the business. And if in fact rates take off and move up, we're even better off. Yeah. But if we don't get our costs under control, we have a problem.
So I think that's interesting because we're a little bit ahead of the curve relative to you in terms of the regulatory pressure cost, which in the larger bank space has just sort of fundamentally changed the equation for what the efficiency ratio of a well-run large bank is. And as is inevitable in the world of regulation, despite what people may say, it gets pushed down, and it's getting pushed down now. And you guys are beginning to really feel the brunt of that. And so there are things you can do organically to reduce costs, where we and all the large banks just look at our announcements. Every 6 months we announce another fantastic cost-cutting thing with a new fancy name. But strangely enough, we need to do another one 6 months later. But tried and true for us, acquiring other banks and taking out infrastructure costs is, while the revenues stay relatively stable, it's a terrific way to try to combat that creep in our operating costs. And so we will continue to do that to the extent that regulators will let us, because we are really stuck in a world where in flat interest rates and in a world in which costs don't tend by themselves to go down, we are totally focused on acquisitions as a method of trying to control our overall efficiency.
I think that's really a good point. And I look back at PacWest and its success, and it's a bank that's operating at about 180 basis point return on assets. And I think the acquisition program has been an integral part of achieving that, because it is a bank where its entire acquisition focus was to buy the bank that was across the street. Not because they feared that bank was too competitive or that they were going to lose customers to it. No, the answer is, if I buy the bank that's across the street, I can take 75% of the cost out and continue to drive my profitability. So today, PacWest, their average deposits per branch is $185 million. You can be profitable structured that way. And so I think, and I'm one of those that thinks that the M&A activity is going to continue to be robust because of the pressures to control our costs, just as Todd said. There aren't very many other levers that we have at this point to do it. The other thing PacWest did was it bought Capital Source, thanks to Frank and his partner, which doubled our size, and they were a specialty lender, though of mainly bank-type loans, but it gave us a more robust asset structure to go with it, and one that was then unlinked from our specific geography, and it's a national footprint.
Because always, I mean, the other alternative is always moving into asset categories that have higher inherent returns. The danger, of course, is doing it in ways in which you challenge your credit quality. And if you look at Capital Source, and I think this is the same theory behind CIT and One West, which is combining very strong liquidity generator with a high yielding, but over history very risk controlled, higher yielding business. And so those two transactions, which are hard to reproduce because there aren't very many of those high yielding, low credit risk businesses out there, is a good example of trying to do something about the efficiency issue, but on the revenue side rather than the expense side.
I'll throw out one more question to both of you. Todd, you work at a big bank. John, you're plugged into everybody in the industry. Mm-hmm. Big bank as buyers, how rapid is the return of the big regional bank?
It's a very interesting question. We think that the door is very wide open. the challenge, and in fact, we actually think we have a bit of an advantage. And if you think about, from what I know of, and I don't want to break anybody's confidence, is of the BB&T Susquehanna, not Susquehanna, the one they did prior in Kentucky.
Yep.
The original thought of the sellers was, oh, we want to go with a medium-sized bank because big banks have too many regulatory issues, right? But the reality is we're way ahead of you guys on those regulatory issues. They're coming to you. We know what our risks are and where our regulatory position is. And many of the mid-sized banks, I don't think they're quite so sure. And so the reverse due diligence that you have to do as a seller to try to figure out if there's real regulatory risk in your buyer is, in fact, better and easier to do with the large banks. So the certainty of execution of the transaction, oddly enough, is now greater with a large bank because it knows exactly what its regulatory issues are. There was some feeling that the Fed wasn't going to allow large banks. Well, I mean, I don't think Chase can buy any of you, right? But BB&T certainly could, or a Comerica, or any of the banks that you traditionally think of as large banks, but not the very largest. They're back in the game. The only thing for them is they have to be thinking about their own internal resources, which today they're still putting tremendous amount of internal resources into trying to comply with. I won't even go through the list of acronyms of things that they're complying with. So they want to use their Fed applications wisely. So they're going to go and not do 3 deals that are sort of okay. They're going to look for that one really good deal. Royal Bank of Canada, a good example. I mean, they paid a premium price for a premium property.
This time they mean it, though. The U.S.
Sorry.
This time is going to work.
Yes. As a former employee of TD, I can laugh at that. Yes. This time they mean it. The point there is Royal Bank of Canada is a huge bank, and I know how the regulatory conversations went there, and it's pretty clear that the Fed is going to allow transactions of this type. So I think the big banks are back in, but what they're sort of waiting for in many cases is for your consolidation to go another step. Because for me to buy a $2 billion bank, that's a lot of work. For me to buy a $10 billion bank,
It's the same
great.
amount of work,
Right.
5 times.
Right. So
I think I agree completely with what you said, and I think what City National, what that transaction says to me, if you want to be a super regional player,
Yeah.
you better get going, because there aren't that many trophy properties
Absolutely.
in these larger metropolitan markets until you get new aggregations that come up behind them. City National was not that trophy property back, 10 years ago, 15 years ago. It is today. It's a $30 billion bank and with a very sophisticated product set. So,
Pretty good.
anyway, I think we've exceeded our time and worn out our welcome.
It was a lot of fun, guys. Thanks.
Thank you.